You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey everyone, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today we're going to be talking about tax scams that we continually see out there on the internet, whether it's TikTok, online forums, YouTube's, communities, you name it. We're seeing a lot of these scams. We want to make you aware of them so you don't make the same mistakes. We're talking about 3 scams and then 2 questionable strategies that you may want to think twice about using. So make sure you stick around to the end so you don't miss it. We'll be diving into all of these in just 1 minute. Are you ready for the 2025 tax changes under the new administration? With new leadership in Washington, the tax landscape is shifting fast. These are some of the biggest updates we've seen in years, and if you're not proactive, you could be leaving thousands on the table. But don't stress, we've got exactly what you need. Access our exclusive 2025 tax changes resource, an in-depth tracker that breaks down what's new, what's changing, and the strategies that you need to stay ahead. This isn't just some generic checklist. It's a powerful and live resource tailored for real estate investors like you. Head on over to www.therealestatecpa.com/2025 tax changes to access this essential resource. You'll get immediate insights into how to navigate the new administration's tax policies and how to keep more of your money in your pocket. That's www.therealestatecpa.com/2025 tax changes, because smart investors don't just make money, they know how to keep it. We'll see you over there, but right now we'll jump right into today's episode. All right, and we're back. So tax scams, it's like this never ends. People are always thinking about creative ways, not always legitimate ways, to reduce taxes. So excited to talk about this today. The first one we're going to be talking about is equipment leasing. So the way that equipment leasing works is you would buy a bunch of equipment. You would then lease this equipment to a company using a master service agreement, also known as an MSA. And then you'd be able to depreciate this equipment using bonus depreciation and generate massive losses. But Ryan, why is this a problem?
Yeah, like a couple of these strategies we'll talk about, it doesn't truly factor in the passive activity loss rules of IRC section 469, which is where we also talk about real estate professional status, the short-term rental loophole, things like that. So this is kind of something our firm, we feel like, is kind of a expertise of ours specifically. But bottom line is that basically the way this is going to be structured 98% of the time probably is that you, as the one who's investing or purchasing the equipment, it's going to be passive to you. Okay. So just like even rental properties, when you're passive, it's going to be passive, and any losses that you might generate, even if you bonus depreciate it, section 179, and get this huge loss in the first year, that is all going to be passive. Well, guess what? If you don't have any sort of passive income or passive gain, it's just going to sit there. But the things that kind of, I don't know if you want to call them, not the syndicator, but the sponsor or the person who's telling you about this, is that they're generally going to tell you that it's actually going to be able to offset like your business profits, which are going to be non-passive, or your W-2 income, which again is non-passive. So it's kind of a misunderstanding there, but really the crux of it is the passive versus non-passive buckets. And the misunderstanding is that this is almost never going to be truly non-passive unless you're really doing this as a business. If you are simply buying it as like an investor, hey, I bought some equipment and then boom, I just hand it over to some company to lease it from me, and you're basically hands off, it doesn't sound like you materially participate.
Yeah. So kind of the way this works at the end of the day, right? If you're signing a master lease agreement with another company, they're going to lease the property, the equipment to someone else, right? You're not providing any substantial services. You're not materially participating. It's just like doing a 12-month lease, right? Where you're leasing a property for 12 months. There's not much meat on the bone for material participation. So there might be some exceptions here if you're providing substantial services and you're materially participating. But if you're just buying equipment and leasing it out and doing virtually no work, it's going to be passive. And this is where the scam is that the promoters of this business are telling you that it's going to be non-passive. And that's just not the case. You have to put in the work to make it non-passive and be able to offset your other income. That's, long story short, equipment leasing in a nutshell. Ryan mentioned before the episode, like, here's a litmus test for this. If you're not doing any work and they're giving you non-passive losses, chances are, with the exception of oil and gas, it is a scam. Just keep that in mind. That's credit to Ryan right here. All right. So long story short, equipment leasing, probably a scam if they're telling you it's non-passive. Now, there's another scam out there, solar scams. Solar tax credits in and of itself, it's not a scam. But again, the way that's being marketed makes a scam. Ryan, do you want to take this one?
Yeah. Super similar to the lease equipment type stuff. Basically, they're trying to say invest in solar panels installed on buildings as part of like this big solar farm. And you, as the investor, can basically take these tax credits and tax losses and make them non-passive, just like we were talking about, right? So the main issue, again, is passive versus non-passive, material participation versus non-material participation. And what they're touting is that, again, you can make it non-passive. And we've even seen, at least from my own experience, Tom, I'll just take a second, in some of these where we had questioned clients of ours who were like, hey, I'm going to get into this. What do you think? Basically, I asked them to have the CPA, who was kind of like, quote unquote, like backing it, to say, hey, tell us how they're going to materially participate. And it was crickets, right? Maybe they just thought like, hey, this isn't worth our time. Or maybe they were like, you know what, shoot, we can't like help them understand how they're going to materially participate. Because when it really got questioned, they couldn't really help us understand what are the activities that they are going to do to get them to be more time than the person who's actually involved in that business, right? Because material participation, we've run through this multiple times, but the main one that they tout is the 100 hours minimum and more than anyone else test. It's just super unrealistic. Are you actually, as an investor, going to go to these solar farms and take a look and watch installation and pick out these things and do that? Probably not, right? And so you're going to be passive. But the main issue here is they're promoting, like we're saying, they're promoting you can get these credits, these losses as non-passive. In reality, very similar to the leasing equipment, it's going to be passive.
Yeah. So basically, the solar credits themselves are not scams, just to be completely clear.
Right.
But if you're investing in these things, hoping for them to be non-passive, unless you're the general partner or the sponsor, putting the deal together, making the entire thing, like you're running the operation here, you're most likely not going to be materially participating. Because like Ryan said, you can't use the 100-hour test. You're not doing substantially everything yourself, that's for sure. And then on top of that, you're not doing 500 hours, right? This is kind of like you're an LP in a deal, and it's just how it works. So the scam is in believing that is non-passive. Now, I've also seen another variation of solar investments come across my desk, and this is not a scam. I'm just saying you're letting the tax tail wag the dog if you do this, right? Basically, the entire premise of this was you're investing into a fund, and you're getting these passive activity credits, and you're using them to offset your passive activity income, using it to reduce your taxes. And there's an arbitrage between the amount you're investing and the amount you're getting passed back that makes it worthwhile. However, from an investment merit perspective, there was no real other income coming in. Like you're doing this only for the tax benefits. And maybe that makes sense for some people. But for me, when I looked at this investment, I was like, why would I put money up, right? Risk my capital to hopefully get these solar credits that there's no investment merits to it. So I'm not saying that's a scam. It's not a scam from as far as I was able to tell, but it's just, you're letting the tax tail wag the dog. You're investing money simply to get credits to offset future passive income. Basically, it's just, in my opinion, highly risky. You're risking capital for no real investment benefits. So solar, you have to watch out for solar stuff. If you get into a solar investment, please do speak to your tax advisor, someone who's qualified in Section 469 to help you navigate how and if and how you can actually use these to your advantage. Okay. So just be careful out there. That's the point.
Yep. And last comment I just want to make, Tom, before we move on. It was just in, I think, the fall of 2024. The IRS had like some sort of, don't quote me on this, anyone, but some sort of notice that came out that said, hey, taxpayers, please be aware. There's all these like solar credit things coming out. So the IRS has like become very aware of these kind of scams. Tom, just to maybe help people real quick before we kind of move on, for the word scam, at least the way I see it, is like there basically is some sort of variation of truth to how something happens, but it's kind of getting clouded with like not a full understanding. I think some of these sponsors and people who are putting these things together, they may not have malicious intent. And I think that's maybe what some people use for the word scam. That's not always what's happening here. But the way that we are talking about it here on the show is just basically it's being touted so much as something that's so easy and basically no risk, and it's really great, you don't have to do anything, that we just want to kind of make people aware of these things so that you're thinking about them as, is this a scam? Is someone not giving me all the details and now I'm being taken advantage of because there's a lack of understanding there? We want to basically fill that gap of understanding for our listeners so you're not being taken advantage of and actually working with how these things work in truth.
Yeah, the reality of the situation is, with the exception of oil and gas, which is clearly carved out in the tax code, it's been around for years, there's not really many investments you can make passively that are going to give you non-passive income, right? Or non-passive losses. There's always some type of material participation bar or even real estate professional status in the case of rental properties, that there's some work that goes involved to make these things non-passive. It's just the reality of how the tax code works. So if you hear that something is non-passive and you're not doing any work and it's not oil and gas, you really have to question it. And I would strongly suggest you go to your tax advisor and ask them to review that with you, right? Because it may be something that we're not mentioning here on this episode that comes across your desk. You just want to make sure you're protecting yourself. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. So there's another scam here we do want to talk about. It's called art donations. Right. And the way that this basically works is you're buying art at a quote unquote discounted price. You're getting it reappraised at a much higher valuation. And then you're holding it for at least a year so that when you donate the art, you're donating it at its fair market value and you're getting this outsized charitable deduction. Right. So you paid, I'm going to give you an example. You paid $100,000 for this piece of art and then they're valuing it at $500,000. You're holding it for a year and now you're donating it at $500,000, right? And you're getting a deduction of $500,000, right? Now, this is a scam because the valuations are often inflated to generate this large deduction. So the IRS will look into what you originally purchased it for and what the valuation is. And, they're going to pick apart that valuation, okay? And if it's not a legitimate valuation or there's holes in the valuation, that's where you're going to run into trouble.
Yeah. And if I'm not mistaken, this is on the Dirty Dozen list. It's kind of one of those things that they're frequently auditing. So it's not something that you want to get into probably in the first place if you're concerned about getting audited. But this is especially kind of the point here is it's especially getting flagged right now. It's kind of like almost like a top 10 wanted FBI list. They're especially looking for these people. They're especially looking for things like this. And it is just like very interesting. I get the whole maybe hold it for a year to kind of give some credence to like, hey, over the course of a year, it did, inflate. If they were to buy it and sell it the next day, it's okay. We can't get a $400,000 reevaluation the next day. I think they're trying to be kind of sneaky and say, oh, over the course of the year, it quadrupled in value. Just a little bit unrealistic. I think for most art, there probably is genuine. Again, this is part of the thing with scams. There's a little bit of truth, but oftentimes it's then overdone with things that like shouldn't be evaluated like that. Or like taken the wrong way, right? And that's kind of, I think, the scam. It's kind of baked in with a lie, some little bit of truth is kind of the sneaky part of this. So yeah, just be careful on those valuations. That's where you're usually going to lose under an IRS audit.
So yeah, again, this is just another one, and they always attack high-income earners. People have the disposable income to make these types of investments because you really hate paying taxes, and we get that. We see it all the time, but these scams are just not it. So if you come across these, if you're a client of ours, please come talk to us and we'll take a look at it. We'll make sure whether it's a scam or not, we'll let you know. But if you see these are red flags and you should definitely be proceeding with caution or be speaking to an advisor about this.
Yeah, it's another one of those things where literally no work on your part and you get a massive deduction. Put in $100,000 and get $500,000 of deduction, no risk, all these things, and it's going to be easy peasy. Yeah, it seems a little too good to be true.
Yeah, for sure. Now we have two more things that we're going to talk about here. These aren't necessarily scams in the way that we're talking about here, but they are questionable strategies. They do carry significant risk, and they're often ripe with abuse. Okay, so you just want to kind of proceed with caution on these as well. The first one is a discounted IRA rollover, and I want to give a quick overview how they typically work and then why this specific strategy we're going to talk about is questionable. Okay, so when you have an IRA and say your IRA has $200,000 in it, right? And over time you've had earnings and the stocks or whatnot you bought in the IRA appreciated. If you were to go ahead and transfer that, you're converting it from a traditional to a Roth, or you're making a withdrawal from it, whatever the case is, you're going to do that the fair market value of those assets at the time you're making that, right? So the way it works is say the stock market takes a 50% hit or a 20% hit, right? then that could be a lucrative time to make a conversion, because now instead of saying paying tax at a stock that's 200,000, maybe your portfolio is only worth 150 or 100,000 in certain cases, right? So you're taking less of a tax hit. Now, this works particularly well with publicly traded securities because the market is very clear on what those values are. You're not making these values up. The market determined that Tesla is down 50%, then that's the value at the time of the conversion. However, there's syndicated investments where what happens is you say invest 50K or 100K, whatever it is, and then they're doing a valuation. See, keyword here, valuation on it, and they're telling you that it's worth less than your $50,000 or $100,000 investment, right? Maybe it's only worth 40,000, or maybe it's only worth 35,000 while you're invested in this asset, and now you're doing the rollover. So you invested 50K, right? Now they're telling you that your investment's only worth 35K, right? And it's based on the valuation, okay? So I'm not telling you this is a scam, because discounted IRA rollovers, they're a legitimate strategy. But when you're using these valuations here, that's something questionable. I'm not saying that it's a scam. I'm just saying it's something questionable, and you should proceed with caution, because guess what's going to happen? If it's ever scrutinized, they're going to pick apart the valuation. It is the valuation of that investment. You made a 50K investment, say January 1st, and now they're telling you June 30th it's worth 35K. Is that legitimate, right? Hey, tax smart investors, real quick, just wanted to remind you that I do have a YouTube channel that I'll be posting on relatively consistently this year, covering tax strategies, tax tips, and tax news for real estate investors and business owners within that 7 to 12 minute range. So if you do like that shorter form, hard hitting content, you can go ahead and find me at www.youtube.com/@ThomasCastelli, or simply by searching Thomas Castelli CPA on YouTube. Subscribe to the channel and drop me a comment what video you want to see next, and that just might be my next video. I'll see you there, but for now, we'll dive right back into today's episode.
Yeah. And just to add it to not a major topic we're going to talk about, but it also comes back to even something very similar to conservation easements. I'm not going to spend a whole lot of time on it, but just the point to kind of tie it into something that our listeners, you're very aware now, like the IRS is picking apart conservation easements. Why? Because of the valuations. So we keep coming back to the whole valuation part being the issue, and a very easy part for someone to manipulate that in order to get the tax benefits that they're looking for. So all of these kind of come back to the valuation and basically manipulating that to be basically a little bit too good, more valuation than really it should be worth. And that's where the opportunity is for taking advantage of these could be good strategies, but taking advantage of the valuation part and that being illegitimate.
Yeah, for sure. So again, discount IRA rollovers, not a scam in and of itself,
right?
But it's ripe for abuse with those valuations. You just want to be careful, proceed with caution. You don't want to put your IRA at risk, right? Because if your IRA is at risk and they find out there's fishy things going on, they could disqualify your IRA, basically making a withdrawal, and you're paying taxes and penalties, and you just don't want to do that. So if you see that, just proceed with caution. Other one is deferred sales trust, right? And I know that I'm going to mention this here, and I've not mentioned this yet on the show, because I don't want a flood of DST people, deferred sales trust people, and attorneys sending me a bunch of information on why this is legal, right? I understand the case for it. Basically, with the deferred sales trust, what you do is you sell your asset to a trust. Then the trust sells the asset to the buyer, right? Now the money is in the trust, and basically you have an installment agreement where the trust pays you out over time, and you're spreading out your capital gains tax over a long period of time, while the money that you had, like the sales proceeds, are growing in the trust, right? So the trust, basically what happens is you sell to the trust sells to the buyer, the trust holds the money, the trust invests the money for you to keep it growing over an extended period of time. And then you're basically receiving money from the trust over a longer period of time, spreading out that capital gains tax that you would have paid had you sold directly to the end buyer. And these are similar to monetized installment sales, which are on the Dirty Dozen list. I think they made them listed transactions now, but they are scrutinized. And the concern there is that while there is a legitimate case that deferred sales trusts are indeed legitimate using installment sales under IRC section 453, there is risk, okay? There is risk that these could be investigated just like monetized installment sales were. And if they are, you could be putting yourself at risk.
Yeah. And I think, Tom, like the main part that makes this most risky from my understanding is kind of the control part, right? who has control of the funds, the money, the sale. And if you do things appropriately, and again, I think there is a way where this can be fine, this can be legit, just like with the other things that we've talked about, right? These other things, the discounted IRA, rollover, stuff like that can be legit, but again, has an opportunity to go wrong, I think, with the control part. And I think if we put this out and you start getting comments from attorneys and other CPAs that are like, no, it's legit, it's legit. Yeah, if you do it right, and it's the control piece. So I think the thing that we have to be careful of is, could the IRS potentially see that you actually have control? Or is it truly that the trustee has control? I think that's the main part. Are you selling to yourself? Okay, that's pretty illegitimate. Are you actually selling to a third party trustee that actually has the control? And so I think that's really the crux of where most of the risk is. And if you're going with someone who's done this one time, probably a lot of risk. Maybe if you go with a specialty firm that's done this a lot, all of these things, it can be legit. But again, just another opportunity. Things could go wrong pretty quickly here if you don't do this right.
Yeah. I just want to be clear. This is not a scam. This is why I didn't put it under the scams, put it under like the questionable strategies, because here's the thing with the monetized installment sale, which is why it was on the IRS Dirty Dozen list, which is why it's a listed transaction, is with the monetized installment sale, you're selling it to a dealer. The dealer is selling it to a third party. And then basically when you sell it to the dealer, you're using an installment sale. So you have an installment note, right? You basically have, it's kind of like a promissory note. Let's just look at it that way. Then you're going to the bank, and the bank is lending, you're using the promissory note as collateral to get up to 95% of the value of that promissory note in a lump sum of cash. And basically the way you're structuring it is that the promissory note that you're getting paid from the dealer is paying off your loan, right? So you're kind of like getting a basic wash, but you're getting to access up to 95% of your capital right up front, right? So that's where it makes the monetized installment sale, it's kind of substance over form. That makes that a scam, okay? Or an extremely risky strategy if you're going to use that. This is structured similarly. The difference is here is you're giving it to to your point, Ryan, the trustee is in control of the money. You're not getting it all up front, right? They're investing it in the trust, and then you're getting paid out over time, okay? That's where the difference is here. But because of the similarities with the monetized installment sales is why we believe it's a risky strategy, okay? And it could be pursued at some later point in time, just like the monetized installment sale was, right? Just like land contraries and easements were. But assume that's not the case, right? Assume that that's all legit and that never happens. The risk you're taking with the deferred sales trust is you're having a third-party trustee in control of that trust, in control of your funds, right? And that's where like the legitimate investment risk comes in for you, right? What if they misinvest it? What if they don't follow your wishes? What if something happens, right? That's where the risk comes in. So not a scam, but it's one of those questionable strategies that you have to question. On top of that, one thing I did not mention is that there's typically setup fees and ongoing annual fees that make it a costly thing to do. So again, please, if you're a deferred sales trust person, don't email me with all the illegal stuff. I've seen it many times. I agree with you. There's definitely a case to be made. And that's why it's not a scam. I'm just putting it in a strategy that I would say is relatively risky, okay? Or carries some risk and something that I would not personally advise someone to do. But it's not a scam, okay? Again, and same thing with discounted IRA rollovers. Not a scam. It's just there's room for abuse. So bringing these to light here for you today, because we get questions on this stuff all the time, right? From people within our community, potential clients, current clients, and we're just trying to help you navigate the tax maze, right? All these potential tax traps so you don't fall into one of them and get stuck with back taxes, penalties, and interest, okay? It's not about being risk averse. It's about being aware of the risks that are out there, okay? If you want to go into the jungle and get to the other side, we're all for helping you navigate that, but we want to help you avoid those bear traps. That's what we're trying to do. So hopefully this episode was helpful for people out there who may be running into these things. If you do have questions, do come contact us. We have a free Facebook group where you can post your questions. That's www.facebook.com/taxsmartinvestors. You'll be able to find us there. Or if you are looking for an advisor, www.therealestatecpa.com/podcast. We'd love to be able to help you out, or check the show notes for that link. Any parting words before we leave, Ryan?
Yeah, I think just my final comments. Again, if it seems too good to be true at first, let that be a little bit of a litmus test. If it basically is going to require just a capital investment with no time, be very skeptical of anything like that. And if it seems like it comes with almost no conversation around downsides or cons or risks from the person that you're talking to, they want you to do this, right? They're probably the owner of this or a business salesperson, whatever. Just make sure you understand the risks. We're kind of here to try to balance some of that. Hey, here's some of the pros, here's some of the cons, but just be careful that you really get information about the full picture, not just the shiny object of the benefit. Be well informed.
Absolutely. And my final comment here is, look, just to clarify on the episode here and how we did this, right? Non-passive solar credits when you're not materially participating, a scam. Okay. If there's someone's telling you that's how it works, that's a scam. Equipment leasing businesses, when you're not actively involved, you're not providing substantial services, you're just leasing it out under a master lease agreement, not doing anything, and they're telling you it's going to be non-passive, that's a scam. Okay. Art donations with really questionable valuations, that's a scam. It's on the IRS's Dirty Dozen list. They are watching for that. Okay. These are scams. These are in the scam category. And we just told you why. Questionable strategies or strategies with risk that you need to watch out for with an asterisk next to it, going to be discounted IRA rollovers, specifically with syndicate and funds where they're valuing your investment less than the amount you invested within a short period of time. That's questionable. It's something you should tread lightly. And the same thing with deferred sales trust. Again, not a scam. There's plenty of merit, plenty of substantiation out there for it being a legitimate strategy. However, because it shares similarities to monetized installment sales, which made it onto the IRS Dirty Dozen list and our listed transactions, you just have to be careful with the risks that are out there. Okay, so again, hope this helps. Looking forward to catching everybody on the next episode of the Tax Smart REI podcast.